All right, we'll just give it one quick minute as more attendees enter the Zoom, and then we will get started with our presentation.
Good.
All right, I think we can get started. I wanted to welcome everyone to today's webinar on managing student loans during the coronavirus pandemic. My name is Walter Susskind. I'm the Deputy Communications Director at the Student Borrower Protection Center, and I'm going to start the presentation by welcoming Mike Saunders, the Director of Military and Consumer Policy at Veterans Education Success.
Good afternoon, everybody. Thanks for joining us on Juneteenth, an important day marking the end of slavery in America. Racism persists in too many ways in America, including in the realm of student debt, where students of color are disproportionately burdened with debt and targeted with illegal loan practices and deceptive recruiting by for-profit colleges. But the laws are changing and students have more rights. We're here to talk about managing student loan debt. Americans collectively owe $1.3 trillion in student loan debt. 130 million of that is privately held debt. I'm Mike Saunders, Director of Military and Consumer Policy for Veterans Education Success, a nonprofit dedicated to protecting and defending the integrity of the GI Bill. I'm an Army vet, former tanker, and I've spent the last decade working in the veteran space. Among other things, I've been helping veterans successfully reintegrate back into society by making sure they get a full return on investment for their hard-earned GI Bill dollars. In the last 3 months, the fallout from the COVID-19 epidemic has been 40 million newly unemployed Americans. The speed of the economic collapse is truly without precedent in American history. If you were struggling with student loan debt before all of this happened, you are not alone. Roughly 43 million Americans, 1/6 of the population over the age of 18, have some sort of student loan debt. We're here to help you figure out how to manage your student loans. About 250,000 active duty service members carry student loan debt, much of it acquired before they came into service. And approximately 25% of veterans carry some sort of student loan debt. Veterans, many of whom are first-generation students, often accrue student loan debt when they go on to get postgraduate degrees or when they attend predatory schools with overpriced tuition that drains their GI Bill before they're able to graduate. That's why I'm here with Corey Titus from the Military Officers Association of America, Jen Davis of the National Military Family Association, and Mike Pierce of the Student Borrower Protection Center to help you manage your student loan debt.
And thanks, Mike. And my name is Corey Titus. I'm the Director of Veterans Benefits and Guard and Reserve Affairs at the Military Officers Association of America, or MOA. I'm also an Army vet, former infantry officer, and I used the GI Bill when I went back to school to pursue a master's degree. As mentioned earlier, a quarter of all veterans graduate with student loan debt, and some of that is acquired before joining the military, some is acquired after the GI Bill runs out, or to meet with other costs, and either in undergrad or postgraduate studies. And regardless of when the debt is acquired, it's an additional burden that makes the transition from service member to veteran just a little bit more challenging. And I think working my portfolio, problem I see time and time again is that the military and the VA doesn't do a good job steering service members into programs like the public service loan forgiveness or income-based repayments, which can go a long way to getting out from under student loan debt. And I appreciate the chance to be here to talk about these important issues. And I think it's important to remember that it's not just service members or veterans who are impacted by this, it's also tied to our families as well.
So thanks for that nice segue, Corey. It's really good to be here. My name is Jen Davis. I work at the National Military Family Association. I'm a Deputy Director of Government Relations for NMFA. I'm also an Air Force vet who used the Montgomery GI Bill and a year of post 9/11 to further my education after separating from the Air Force. And I'm also the spouse of an active duty, currently serving airman, who's currently serving overseas. So a little bit about NMFA. We are in our 51st year. So we've been around for a little bit. And we were established as an advocacy organization. Through the years, we've added programming to help fill gaps that many military families face. To help reconnect after an injury or a deployment or any kind of separation like that. This year, we're offering free virtual camps in light of the pandemic. And if any families who are listening are interested, please go to our website at militaryfamily.org for more information. But we also run a pretty robust scholarship program for military spouses, and those funds can be used for traditional education at any level of higher ed. And also they can be used for license and certifications or supervision hours or for spouse-owned business expenses. And while today's topic is on student loans, I'd be remiss not to use this opportunity to encourage military family members to seek out scholarships and opportunities before agreeing to take out student loans. Many military and veteran service organizations offer scholarships, such as NMFA's. I know MOA has a scholarship program too, as well as military relief societies and the Department of Defense through My Career Advancement Account program. And then obviously currently serving service members have access to tuition assistance through DoD. NMFA advocates for military families of all components, active and reserve, serving in all 8 uniformed services. Military spouses are chronically underemployed. 24% is the latest DoD stat pre-pandemic on military spouse unemployment, but we know that's climbed due to the pandemic. In fact, the COVID-19 Military Support Initiative, or CMSI, who surveys military families every week to understand current challenges, has found that 17% of active duty spouse respondents say they've lost their job as a result of COVID. And like many who face unemployment, often military spouses seek to further their education as a means of making themselves more marketable to employers. However, one concern is that sudden turns in the labor market means that they can be left servicing student loans on limited income. So from the student loan debt that active duty service members come in with that Mike discussed earlier, to debt that military spouses sometimes are forced to acquire by an unforgiving labor market, to student loan debt held by National Guardsmen and reservists who have been activated over the last few months. We're all struggling to manage student loans, and hopefully we can find some useful strategies and legal rights that can help. Thank you so much.
Hi, my name is Jared Toma, U.S. Army vet, served from 2001 to 2005. Shortly thereafter, attended DeVry University. Now, with regards to borrower's defense, decided to file a borrower's defense claim when basically had a very poor experience throughout my time at DeVry. And it wasn't what DeVry had promised me. So that what led to the filing of that claim. But with managing my student loans through the coronavirus, really hasn't had a huge effect on me because my loans have been in administrative forbearance. But you always have to be mindful of what the current federal policies are. There's been a lot of news on that front. So trying to stay educated, trying to stay mindful of what the status is of the institution you attended. So always trying to stay educated. That's the biggest thing, and be mindful of where your loans are at. So I've had to try and stay educated on that when my forbearance is up. Thankfully, it's been extended out for extended period of time, but I can't stress that enough. It's just stay educated, and if you haven't filed a claim, maybe do some research on that, see if you may potentially qualify. And also, if you already have filed a claim, be mindful of what the policies were at that point in time and what they are now, and see if, where are you going to fall underneath the old rules or the new rules.
Thank you so much. This is Seth Brotman. I'm the Executive Director of the Student Borrower Protection Center. And I'm going to be brief here before I turn over to my colleague Mike for the presentation. But I just wanted to echo something that Mike Saunders mentioned, which is there's now $1.7 trillion of student loan debt, and 45 million Americans get a student loan bill each and every month. And I think we say this to let people on the webinar who are really worried about their student loans, worried how they're going to make their next payments, worried about what happens when this temporary relief runs out, to let them know you're not alone, that millions of Americans just like you are really struggling under the weight of this debt. But I think what today's presentation is about is that the organizations on this call have fought for years to provide really strong protections to ensure that if you're struggling, if you lose your job, if your income gets cut back, that there are options and benefits and programs that could exist to really help you. And over the long term, especially if you're involved in public service, that there are meaningful ways to try to reduce that student debt load. So I think that's what you're going to hear about today from my colleague Mike in a minute. But one of the things that I did want to flag and just take 1 minute on was before my current job, I used to work at the Consumer Financial Protection Bureau, including years at our Office of Service Member Affairs. And what we saw, unfortunately, is that too often service members, military families, and veterans are the canaries in a coal mine, that when companies are ripping borrowers off or markets fail, too often it's military families who are really the tip of the spear in terms of bearing the brunt of those practices. So in the student loan market, we've seen companies deny borrowers their SDRA rights. We've seen student loan companies rip off disabled veterans. We've seen predatory schools really target military families. And with the economic downturn and all the economic strife around the coronavirus and the economic fallout, I think we are all really worried about what is happening in the market, what's happening to student loan borrowers, and how a lot of the practices that we saw, 10 years ago or 5 years ago in terms of targeting military families are going to rear their ugly heads again. So I think if you feel like you've been ripped off, if you think something just doesn't seem right with your student loan, I know that any one of us on the call would love to hear your story, love to help out. And I think what we have seen is how the problems that are happening rarely ever happen to just one borrower. And if they're happening to you, if they're happening to your family, if they're happening to your clients, most likely they're also impacting thousands, potentially tens of thousands of other military families just like you. And these are the folks that can do something to help stop it, both in Washington, in state capitals, or taking industry on directly. So you're going to learn a lot today about how to manage your student loan debt, but we'd also love for you to keep your ear to the ground and let us know what's happening out there and how historically predatory student loan industry that has unfortunately targeted military families, what they're up to now, and how we could be helpful. So with that, I just wanted to turn it over to my colleague, Mike Pierce, for the webinar today to provide a bunch of different highlights and walk through about managing student loan repayment during the coronavirus pandemic.
Thank you so much for the introduction, Seth, and thanks to everybody for joining us today, especially to our colleagues at Veterans Education Success for co-hosting this with us. As Seth mentioned, my name is Mike Pierce. I'm the Policy Director at the Student Borrower Protection Center, and along with Seth, I worked at the Consumer Financial Protection Bureau for a bit more than 7 years before we left to come start our new nonprofit here. All of that time I spent helping individual borrowers, including service members and veterans, navigate the system to both take out and repay student debt. And in the course of that work, I had the fortune or the misfortune to work on a number of enforcement actions against some of the largest for-profit colleges and student loan companies, including cases where service members and veterans were cheated out of their rights. So this is something very near and dear to my heart, and I'm very happy to be here to talk about the often complicated but really shouldn't be overwhelming set of benefits and protections that exist for military borrowers. But first, I'm going to talk a little bit about the student debt crisis, what that means for military borrowers, and what that means in the context of some new federal protections that were put in place in response to the coronavirus pandemic. So as my colleagues mentioned at a few different points so far, the student debt crisis is a big problem for everybody, but it's uniquely problematic for military borrowers. More than 200,000 active duty service members owe nearly $3 billion in student debt, and veterans and their families owe billions of dollars more on top of that. What that means now, particularly for borrowers that have federal student loans, there are a new set of benefits and protections that have been put in place by Congress in response to the coronavirus pandemic through the CARES Act, which was the bill signed by President Trump at the end of March that includes a number of different new rights for people that I'll talk about in just a second. But there are a number of legacy programs that help people manage their student debt that have been on the books for a decade or more. Or in the case of the Service Member Civil Relief Act for many years longer than that, that provide specific benefits for military families, benefits for people working in public service, and then general protections against economic hardship. And I'm going to talk about each of those today too. But first, the new rights that borrowers have under the law. The CARES Act passed at the end of March, and as part of that new legislation, which provided support for our public health infrastructure, it provided additional financial resources for businesses. It did a whole bunch of different things to try to protect the economy from the worst effects of the pandemic. It also has some provisions that are designed to protect student loan borrowers. And I'll talk about who's covered by that and who's not in just a moment. But at a very high level, your new rights under this new law are, it was signed by President Trump on March 27th, but this actually goes back to March 13th. So since March 13th, every borrower with an eligible loan has had their interest rate on those loans lowered to 0%. Their obligation to make payments has been suspended, and I'll talk about what that means in just a moment. It also means that any borrower that is working in a public service job has had this period of time where their payments have been paused, count as qualifying payments towards public service loan forgiveness, and we'll talk about the mechanics of PSLF in a minute too. And also for borrowers that are on track to get their loans forgiven just by virtue of enrolling in income-driven payment. So that's loan forgiveness after 20 or 25 years. This period where you don't have to make payments, that also counts towards loan forgiveness under income-driven repayment. And then most importantly for the most vulnerable borrowers, wage garnishment, the seizure of Social Security benefits, and the seizure of tax refunds are supposed to be suspended during this period as well. I'm going to talk in just a minute about who's eligible and who's not, but I wanted to flag first that this hasn't been everyone's experience. So the Trump administration, perhaps predictably, has really botched the implementation of these new rights in a number of important ways. So we are currently working with our colleagues at a couple of other nonprofits to bring a lawsuit against Secretary DeVos for continuing to garnish tens of thousands of people's wages in violation of the law. So the law is very clear. The government was supposed to stop garnishing wages immediately upon enactment of the CARES Act. We are now months since then, almost 3 months later. And tens of thousands of borrowers are still getting their wages garnished illegally. In response to our lawsuit, the Trump administration has returned more than $170 million in illegally seized payments back to borrowers. But if you're having your wages garnished and you're covered by the CARES Act, we want to hear from you. There'll be information about how to contact us at the end of this presentation. But we would love to hear from anybody that's struggling to get their wage garnishment shut off, and I'll talk about how you can do that in just a minute too. But just know that this has been rocky. So First, I'm going to talk about what your rights are. These are your rights. But there is some gap here between the rights that Congress has put in place for borrowers, and that's a recurring theme in our presentation here today, and the experience that military borrowers have encountered when actually trying to navigate the student loan system. So what do you need to know about these new rights? And again, the biggest thing is these are your rights. That's not always everyone's experience. So it's important to understand what your rights and benefits are so that you can protect yourself against student loan companies mishandling these programs or against the Trump administration that frankly doesn't care about getting the details right, even if it costs people thousands of dollars they don't have to pay. So the good news is that for most people, this is going okay. Your payment suspension and your interest rate waiver, so lowering people's rates to 0% and taking away their obligation to make payments, that's happening automatically for most people. The biggest student loan companies have suspended people's automatic payments. They've stopped sending the bills. They've reflected a drop in interest charges on people's student loan accounts. And as of June 2020, so a couple months after this has been in place, for most people, this is going okay. We do have some advice, though, because the transition back to repayment when this all expires at the end of September is going to be rocky. No one, not just the federal government, but no one in the financial services industry has ever attempted what is going to happen in the fall when 30 to 40 million people all have to start making loan payments again after having stopped. And it's going to be a mess. And so one of the things that we recommend people do is if you had automatic payments turned on your student loan account before the CARES Act passed, before your payments were suspended, go onto your student loan services account and turn them off. That protects you against having money unexpectedly taken from your bank account. And you can always turn them back on once you get your first bill. You know how much that bill is going to be for. You know what payment plan you're enrolled in, and you know when the money's due. But we expect there's going to be some pretty significant chaos on the back end of this thing when it's finally over. And so we're encouraging people to shut off their automatic payments to protect themselves. Also, it took a little while for the student loan industry to figure out how to stand up this new set of protections. And that means that lots of people had payments automatically taken out of their checking accounts in March and in April. And if you're one of those people, if you made a payment that was taken out of your checking account after March 13th, you have a right to get that money back. That payment was applied to your loan. And so, it helped you get out of debt a little faster. You might not want that money back, but if you need it for something, you do have a right to request a refund, and you have to do that by contacting your student loan company. The last thing I'd mention, and I talked about this for just a sec, and we could talk about it more in Q&A if people are struggling, but stopping wage garnishment has been a pain point for tens of thousands of people, in part because there's this two-step process that the government has built that is really, really tough for borrowers to navigate. First, the government needs to make the decision to stop garnishing your wages, and Congress did that for them, so the Trump administration doesn't have any choice in the matter. They have to stop garnishing your wages. But the next thing that needs to happen is the government needs to tell your employer to stop taking money out of your paychecks. And what we uncovered through our investigation is that the Trump administration just didn't do that for a month. And so tens of thousands of borrowers' paychecks were seized illegally. A lot of employers heard the law changed. They stopped garnishing wages. Other people had contacted their employer and said the law changed. And so they stopped garnishing wages. But for tens of thousands of people, the government just didn't bother to do anything and didn't tell anybody to stop doing what they were doing. And so that's finally happened now for most people. And there are still, we guess somewhere between 20 and 25,000 people that are illegally having their wages seized. But in the very beginning, it was nearly 100,000. And at one point, maybe it was even north of that. And so we are heartened to see that this is getting better very slowly, but we're halfway through the CARES Act payment pause. And so if you are one of the borrowers that is still having your wages seized and you're covered by the CARES Act, and I'll talk about how to figure that out in just a second, you really should reach out to us. We can potentially help you, and you should also alert your employer immediately. So some common questions. What options are available to me if I'm not covered by the CARES Act? And I'll talk about the who's in and who's out in just a sec. But if you have a Perkins loan, or if you have an older federal loan that was made by a bank and was not bought by the federal government during the bailout a decade ago, what options do you have? So you do have some of the same rights that I'll talk about in just a minute that exist for almost all federal student loan borrowers. You can either by consolidating or just by calling your student loan company enroll in income-driven repayment. There are other options available to you, but you do have to contact your student loan company directly. All the stuff that I just talked about that was automatic that won't happen automatically for you. And so you do need to ask for help if you're struggling, if you have a loan that's not covered. And again, I'm gonna end this part of the presentation by talking about who's in and who's out. Another question that we get often is if you had interest on your student loan account that you hadn't paid down yet, and this is very, very common for people that are in forbearance, for people that are enrolled in income-driven repayment and making payments that are less than how much interest gets charged to them every month. Some people have tens of thousands of dollars in unpaid interest charges that are sitting on their student loan account. And that interest doesn't accrue interest, it doesn't compound. And so it's really important that it stays kind of sitting separate from the amount of money that you owe on the principal of your loan. And people ask us all the time, what's going to happen now that they're not making payments? Is all of that unpaid interest going to get added to my principal balance? And am I going to have to pay interest on that interest? The good news is no. Right now, no interest has been added back to borrowers' loan balances, but we're watching closely to see what happens when the CARES Act suspension ends and borrowers return to repayment. If you were enrolled in income-driven repayment before and you stay enrolled in income-driven repayment after, and again, I'll talk a lot about IDR in the back half of this presentation, you don't have anything to worry about here. This is not going to affect you, but there are other borrowers, particularly borrowers that were in forbearance or borrowers that are going to change payment plans that may end up seeing hundreds, thousands, tens of thousands of dollars in unpaid interest added to their student loan balances. That's kind of a technical thing. And if folks have questions about what that means, I'm happy to answer them during Q&A. But know that we do get asked that question a lot, particularly for borrowers who are enrolled in income-driven repayment. The last common question about the CARES Act has a very simple and kind of a frustrating answer. So I said at the top that this period of time counts towards public service loan forgiveness, but that's only true if you're working full-time in public service, and you were working full-time in public service as of March 13th. So I will talk a little bit more about how public service loan forgiveness works, again, on the back end of this presentation. But know that if you lost your job, if you're no longer working for a public service employer, you do not get credit for this period of time when you don't have to make payments. So that's a little bit of a frustrating answer. It's a place where our advocacy in Washington is trying to change things. We want to see more protections for people that are among the 40 million Americans that lost their jobs as a result of the pandemic. But right now, the law does not give you credit towards public service loan forgiveness if you are not working for a public service employer. So with that, I do want to spend just a second talking about who's covered by the CARES Act and who is not. The good news is the vast majority of student loan borrowers with federal student loans are covered by the CARES Act, tens of millions of people. Everyone with a direct loan, which is basically everyone that took out a federal student loan since 2010, and lots of people that took out a student loan before that. And then everybody that has a loan that was made by a bank and guaranteed by the federal government, or made by Sallie Mae and guaranteed by the federal government, that was bought by the Department of Education during the financial crisis a decade ago, when the biggest banks still made those loans and needed a bailout. So it's a little bit of a happy accident. You happen to take out a loan in 2007, 2008, 2009, 2010, and your lender needed a bailout. So now the government owns your loan and you're covered by the CARES Act. There is information on our website, I'll share a link for that in just a second, about how to figure out what kind of student loan you have. But know that if you have a Perkins loan, which is like a loan that was made up until recently, but older, they're not available now for new borrowers, by your school directly, and your school is your creditor. That's not covered by the CARES Act. It is a federal loan, but it's a federal loan made by your school. And then also lots of people owe, millions of people owe these older loans that were made before 2010 by Sallie Mae or by banks, and guaranteed by the federal government. And those loans are not covered by the CARES Act. And unfortunately, that's a pretty big blind spot in Congress's new set of protections. Together, we estimate between 8 and 9 million people are not covered by the CARES Act and have to figure out how to navigate this mess on their own, and are really at the mercy of their student loan company to do right by them. So how do you figure out what type of federal loan you have, or whether you have a federal loan versus a private loan? And private loans are not covered by the CARES Act either. They're also not covered by the other rights and protections I'm going to talk about for most of my presentation today. The first step here is to call your student loan servicer, the company that sends you your student loan bill each month. For most people that have loans that are covered by the CARES Act, that company is Fed Loan Servicing, Navient, Nelnet, or Great Lakes. There are also some other smaller state agencies that handle these loans. MOHELA is a good example of one. They also handle borrowers that are applying for borrower defense. And so if you've been defrauded by a for-profit college and you're waiting for a decision on your borrower defense application, MOHELA might be your student loan company. You would also be protected by the set of protections under the CARES Act if you have a qualifying loan. So if you have one of those companies, that's another good way to tell whether you're covered, particularly if you have Great Lakes or Fed Loan Servicing. In both of those cases, those loans are covered by the CARES Act. We have FAQs up on our website that help you figure out step by step what kind of student loan you have. And we encourage you, if it's not clear based on your student loan company's website, to check out our FAQs, because we can walk you through step by step how you figure that out for sure. Now, I do want to talk just a little bit about specific protections for military borrowers. There are a couple of programs that exist and have existed for a long time that apply broadly to all consumer debt, but particularly to student debt, both private and federal student loans. That's the Service Member Civil Relief Act. And that protection says that if you have a financial obligation that predates your military service, so only if you brought in that student debt into service and you didn't take on new loans while you were serving. The Service Member Civil Relief Act gives you a right to reduce your interest rate on those loans down to 6%. For borrowers that have loans that are covered by the CARES Act, your interest rate right now is obviously a lot lower. If you have a federal student loan generally, and that's both the loans the government owns and also other kinds of federal loans that are owned by, that were guaranteed by the federal government and owned by banks or Navient or kind of private investors, you have a right to this 6% interest rate reduction. And for about half a decade, that's been automatic. And so what the government does is it looks at a database that shows everybody that's serving on active duty, and it looks at that database every month. And if you show up in that database as an active duty service member, the government will lower your interest rate to 6%. That's not automatic if you have a private student loan. You actually have to contact your student loan company and ask for that protection. So know that you may have been benefiting from the Service Member Civil Relief Act if you're serving on active duty right now and you didn't even realize it, which is a really good example of how government can do this really, really well. But for private student loan borrowers, know that you have this right and know that you need to ask for it. Separately, if you have a direct loan, so really only a loan that was made directly by the Department of Education, generally since 2010, and you're serving in hostile fire, you have a right to a 0% interest rate. And so again, these are loans that are also covered by the CARES Act. So you currently have a 0% interest rate on your account right now anyway. But once October rolls around, this is a really important protection if you end up back in active duty and also in an area of hostile fire. And that protection can last up to 60 months, and it can be applied retroactively. So if any time since 2008 you've served in an area of hostile fire, you can get your student loan company to retroactively credit you for this interest rate savings. But you have to ask for it, and the process can be very cumbersome. And then lastly, I mentioned Perkins loans before as an example of a loan that's not covered under the CARES Act, but there is a separate protection for service members serving on active duty. And that protection allows for you to have a portion of the loan you owe discharged after every 12 months of active duty military service. There are a couple of other options available for borrowers, but they're not going to help you get out of debt faster. The first and the most common is military deferment. That exists if you're serving on active duty or if you've been called up in a national emergency, and we're seeing mobilizations happen across the country right now as a result of the pandemic. You have a right to defer your loans, and if you have a subsidized loan, the government picks up the tab on the interest. Again, because of the CARES Act, that's less critical for lots and lots of people, but know that right exists. It's a right to pause your student loan payment and also to get some help with the student loan interest that's accruing, depending on the status of your loan and the type of loan you have. And know that this right to pause your student loan payment also extends 6 months after you demobilize. Another option here that exists for some student loan borrowers who are active duty military, but it depends on the branch you're serving in, is student loan repayment assistance. So every branch has a different policy for how they help people pay off loans. Often you have to negotiate that during the recruitment process. It's not something that you can just walk in and get. Because you're serving on active duty. But these programs do exist. You should ask about them. We have some more information on our website about them too. It's also important to know that if you're pursuing public service loan forgiveness, that you may want to think really hard about whether getting cash from your branch makes sense, because that loan's going to get forgiven on the back end anyway, and the money you get in repayment assistance now gets taxed as income. So now we've talked about a couple things. We've talked about your new rights under the CARES Act that exist for borrowers that are covered. We've also talked about benefits and protections that are specific to military borrowers, both the Service Member Civil Relief Act that applies to any type of student loan you have, as well as a bunch of other protections that are specific to federal student loans. The next section of this presentation, we're going to spend a little bit of time going into the general rights that borrowers have if they have federal student loans, and that includes general protections that have existed for a decade or more for borrowers that are experiencing financial distress. And then I'm going to close out this presentation. The last section of this presentation is going to talk about private student loans and some specific options that might be available as a result of the pandemic for private student loan borrowers. But for the next little bit here, we're really going to do a deep dive into the rights and protections that exist for borrowers with federal student loans. So every borrower with a federal student loan has a right to pick from a bunch of different repayment plans. The standard plan is exactly what it sounds like. It's the thing you start in when you begin to repay your loans. And for most people, for borrowers that don't have a consolidation loan, and I'll talk about that in a sec too, the standard repayment plan means you pay the same amount of money every month for 10 years. And at the end of those 10 years, assuming you make your payments, you're out of debt. That works really well if you have a modest amount of debt and you have a good job and you can afford to make those payments. It's the fastest way to get out of debt for most people. But it doesn't work if you are having trouble making a job, getting a job, or if you've lost your job, or for military families that may have kind of changes in employment status as a function of their military service, particularly reservists and National Guard members. The standard payment plan doesn't always make sense. And importantly, for people that are working full-time in public service, the standard payment plan is going to make you pay off your loans within the 10 years of service you're required to do. And so you won't get any benefit from PSLF, and I'll talk about that in just a minute as well too. There are a couple other options that I'm not going to spend much time with, but the extended repayment plan is just like the standard plan, but over a longer number of years. You make the same payment every month. At the end of that term, which could be 20 years or 25 years, you're debt-free. And the graduated repayment plan looks just like a set of steps. You start making lower payments in the beginning, typically just the interest on your loans, and over a period of 10 years or longer, you gradually pay off your loan by making higher payments. Your payment amount jumps up every 2 years. Graduated repayment was a really common way to provide some assistance for people early in their careers, back before income-driven repayment was universally available. People don't use graduated repayment very much anymore because income-driven repayment, which is going to be the focus of the next chunk of this presentation, income-driven repayment has been a right for borrowers for more than a decade. It is the most powerful tool to help take your student loan debt and peg it to your income so you can ensure that your debt is always affordable. So what is income-driven repayment? Income-driven repayment lets you make your monthly payment based on your income rather than the balance of your loan. So it doesn't matter how much you borrowed. It could be $50,000 or $200,000. Your monthly payment is the same. It's the same share of your income. So the two key pieces of advice that I'm going to offer when I talk about income-driven repayments that are really the two key insights that I want you to leave with from this presentation. First is you have a right under federal law to make payments based on your income. And there have been lawsuits brought by federal and state government agencies across the country alleging that student loan companies deny people this right routinely as a way to pad their profits. And so I really want to emphasize that point. No matter what your student loan company tells you, with a couple of exceptions, every federal student loan borrower has a right to make an income-driven payment plan, to make an income-driven payment under an income-driven payment plan. The other key piece of advice here that's particularly important as people are losing their jobs is you don't have to have an income to make an income-driven payment. It's a bit of a misnomer. If you are unemployed or your income is very low, you could make a, quote, $0 payment under an income-driven payment plan. It means you don't have to write a check every month, but every month you're enrolled, you're actually making progress towards getting out of debt. And you do that because staying in income-driven repayment over the long term will qualify you for loan forgiveness. So every borrower enrolled in an income-driven payment plan will qualify for loan forgiveness after 20 or 25 years in that plan, depending on the kind of plan they choose and the kind of loan they have. If you're working in public service, income-driven repayment is also the engine that powers the public service loan forgiveness program. And so you get to get out of debt after 10 years of income-driven payments. There are a bunch of different kinds of IDR plans. I'm not going to get into the benefits of each of them. They're all a little bit different, but largely they operate off the same formula. And actually, when you apply for income-driven payment, I'll talk about this in a sec too, you just check a box and say, give me the plan with the lowest monthly payment. And for most borrowers, that's the right thing to do. And so you don't need to be an expert in the alphabet soup of student loan repayment plans. You just need to know that you have a right to make payments based on your income and that you don't need to have an income to make an income-driven payment. So how do you figure out how much you'll pay under an income-driven payment plan? Generally, that's between 10 and 15% of your discretionary income, which is determined based on your gross income and your family size. So I won't make you do the math here, but there's a great calculator on the Education Department's website that will actually take your own student loan data and import that into their calculator, and it'll tell you how much you're going to pay back under all the different repayment plans, standard, graduated, and these IDR plans. But for a single borrower, if you're earning less than $19,000 a year, your payment's $0 a month. And for a family of four, if you're earning less than $39,000 a year, your payments are $0 a month. But your payments could be $5 or $10 or $50, depending on how much money you make if you earn more than that. So know that it's not all or nothing on a $0 payment, but that's a kind of a rough gauge of who's going to be eligible to pay nothing at all. And again, these are really important things to know, and they're really powerful protections for what happens to borrowers who are covered by the CARES Act now, but are going to have to start making payments in October. So we do really encourage people to figure out what the right payment plan is for you, particularly if you've recently lost your job or if you've had a reduction in hours or you're furloughed. Figure that out now while you're not making payments. Work with your student loan company, and I'll talk about how you do that in a second too, to get an income-driven payment. Do it now while you don't have to make payments so that you're on track when the CARES Act expires at the end of September. So I mentioned the biggest benefit of IDR, which is a lower monthly payment, an affordable monthly payment. But also the government picks up some of the accruing interest on your loan under some circumstances. You don't ever have to pay money to pay back old past due bills to enroll in an income-driven payment plan. So if you missed a couple monthly payments before the CARES Act passed, that's okay. The government can use a tool to be able to bring your account current before you start to have to make income-driven payments. You never have to write a big check for past due bills, which is a really good thing to know if you've already fallen behind. It won't clean up your credit, but it will prevent you from having to write a check to your student loan company. You can also change your payment under IDR at any point in time. So even if you were enrolled in income-driven repayment back in the end of 2019, based on a job that you had then and you lost your job, you don't have to wait a year to be able to get a new monthly payment. You just contact your student loan company and they'll take into consideration the changes in your financial circumstances and get you a new payment. And then some of these plans do offer protections against how much interest will capitalize. I talked about this before with the CARES Act. It's how much interest that you have unpaid on your student loan account gets added to your principal balance. So know that depending on the IDR plan you're in, there's some protection against having your balance grow dramatically if you're not keeping up with the interest being charged because your income-driven payment is too low. So how do you enroll in an income-driven payment plan? And I'm going to reemphasize what I just said a moment ago. This is a great opportunity to get on track with an income-driven payment plan. It's hard to be able to keep up with your bills, particularly if you've had a reduction in hours or if you're furloughed or if your significant other has lost their job or if you experience some other financial shock. And come October, people are going to have to start paying their student loans again if they're covered by the CARES Act. If you're not covered by the CARES Act, this is your life right now. So I'm going to walk through at a really high level how to enroll in IDR, but know that all of this information is up on our website, including really detailed FAQs on how you connect the dots. So you have two options to enroll in IDR. You could do it online if you want to use your tax data. So if your income that you earned in 2019 or 2018, depending on whether you filed your taxes or not, is similar to what your income is right now, you can do this all electronically on studentaid.gov. That's great if you didn't lose your job. If you did lose your job, or if you've had a reduction in hours or for other reasons, your income does not reflect what it was last year, which is true for millions and millions of people, then the best thing you can do is to contact your student loan company and fill out a paper application. So I'm not going to talk through the mechanics of those two options today. There's a lot in the slide deck that will walk through that. But the other thing I wanted to flag here is that there's this box you can check that says, give me the income-driven payment plan with the lowest monthly payment. And that's really a powerful tool that prevents you from needing to be a student loan expert to be able to access your rights under the law. And we do encourage that for most people most of the time. So I'm not going to walk through how you enroll online or how you enroll in a paper application. In the interest of time, just know that we have resources on that, both FAQs and the slide deck, and you'll have access to all of that at the conclusion of this presentation. So the last couple things I wanted to flag here, if you are experiencing financial distress and you are covered by the CARES Act, or even many borrowers who are not covered by the CARES Act, you have a protection against negative information showing up on your credit report if you miss a payment right now. If you are getting your wages garnished illegally in violation of the CARES Act, we do want to hear from you, but you should also flag that for your employer, and you might be able to get them to stop seizing your wages by just contacting them and telling them about your rights. And then the only other thing I would flag here is that if you are back to making payments, and you are back to making automatic payments, and your income has changed significantly, and you want to enroll in IDR and you don't want to make a payment you can't afford, it generally takes student loan companies about 3 months to shut off, or about 3 days, sorry, to shut off your automatic payments. So contacting them as soon as you know you've got a change in income and need a lower monthly payment, make sure to ask to shut off your automatic payments when you do that. So with that, I'm going to transition back to talk about public service loan forgiveness, but know that you really do have to watch your loans carefully to stay enrolled in IDR. There are things that make people fall off track commonly. These are problems for borrowers enrolled in IDR, but they're particularly big problems for borrowers that are pursuing public service loan forgiveness. So again, there's some good tips in the slide deck. I won't walk through them now, but just watch your loans closely and pay very close attention to deadlines. I have some information in this slide deck around how to get out of default on a federal student loan. Again, in the interest of time, borrowers that are covered by the CARES Act don't have forced collections against them, and so I'm not going to talk about what that means or kind of how you protect yourself against the worst consequences of default, because they don't apply to lots of people right now. But there's lots of good information in this slide deck about how to get out of default by rehabilitating your loan or refinancing your loan with a new consolidation loan. There are some steps you can take. It means that being in default is not the end of the road if you have a federal student loan. And getting out of default is a thing that you have to do to be able to enroll in income-driven repayment. So I'm gonna finish here by talking about public service loan forgiveness, and then just a minute about private student loans and protections for borrowers. So 25% of veterans enter public service careers after their military service, and serving on active duty in the military is qualifying employment under the public service loan forgiveness program. So public service loan forgiveness, getting started particularly while you're on active duty, is really important so that you can make sure you're maximizing this benefit under the law. So what is public service loan forgiveness? It entitles you to tax-free loan forgiveness after 10 years of qualifying service. And qualifying service is serving in any public service job defined as government service, military service, teaching in a public school, working in a 501c3 nonprofit, or this other category of public service working in a nonprofit organization that's not a 501c3. And to do that, you have to do 4 things, and you have to do these 4 things every month for 120 months. That's work for a qualifying employer, have qualifying loans, which is a direct loan, and we talked about those just a minute ago, and be enrolled in a qualifying repayment plan, and generally that is income-driven repayment. And then lastly, you have to make your payments on time. So enrolling in automatic payments, if you're pursuing public service loan forgiveness, is really, really important. And you have to do these 4 things every month for 120 months. But if you can do it, you have the ability to get an unlimited amount of loans forgiven on the back end. And so for people that have a lot of debt that are working in public service, especially people that are, for example, that are JAG attorneys, this is a really, really powerful protection. So we've also seen some really bad headlines recently around the public service loan forgiveness program. The government and student loan companies are both getting sued across the country for screwing this up for millions of people. But know that if you know your rights, particularly early in your career, it's not that hard to stay on track. The stories about 98, 99% of people being denied access to these programs, that's in part a function of them being handled really badly by the student loan industry and by the federal government in the earliest years of the program, but it's getting better. And the best thing you can do is know your rights. So how do you check to see if you're on track? If you want to check to see if you're on track for public service loan forgiveness, there's a form you can fill out. That didn't exist for the first 5 years that PSLF was on the books. And so the earliest borrowers that were working in public service in 2007, 8, 9, 10, 11, 12, couldn't do a checkup on their student loan accounts, and often made decisions or were advised to make decisions by their student loan company that made them ineligible for PSLF and cost them years of public service. So now you have this form, and we strongly encourage people to fill out the employer certification form at least once a year and every time you change employers. The form's not required, so if you haven't done it before, it doesn't mean you can't fill it out now to get past credit, get credit for past public service going all the way back to 2007. But it's the best way to check up on your loans and make sure that you're doing everything right. So I'm going to end here by talking about private student loans very, very quickly, and then we're going to use the last few minutes here to answer some questions. We know that veterans take out nearly $8,000 in private loan debt if they attend a for-profit school each academic year. Veterans tend to be among the heaviest users of private student loans, which is just a function of them being disproportionately targeted by predatory for-profit colleges. So it means that knowing your rights if you have private student loans is really important, particularly if you're one of those people. So for a lot of student loan borrowers, for borrowers living in the states that are listed on this slide, their student loan company, their private student loan company, entered into an agreement with state regulators that gave them some special emergency protections during the coronavirus pandemic. You have a right to contact your private student loan company and ask to pause your payments for up to 90 days. You have a right to have any late fees for a late payment during this period waived. And you have a right to be free from negative credit reporting and to be free from debt collection lawsuits if you're in default on a private student loan. At least for the 90 days beginning at the beginning of April. So this is changing rapidly. Not every student loan company agreed to this deal, and not everybody lives in a state that's covered by it. And so for everybody else, the best advice is to just contact your student loan company. It's tough to be able to figure out what your options are because there's no big universal government programs that protect people with student loans. But we know that many student loan companies do offer options, maybe even options that are specific to military borrowers. And so the best thing you can do is contact your student loan company and ask for help if you're struggling. If you're in default on a student loan, it's a private student loan. It's a lot like being in default on any other kind of consumer debt, a credit card or an unpaid medical bill. You have a debt collector, you have to negotiate with that debt collector, know your rights under the Fair Debt Collection Practices Act. Make sure you always ask for documentation in writing. If you decide to make a payment, make sure that you make that payment in response to something in writing that says what you're paying back and why you're paying it back. Confirm how that will get reported to credit bureaus, and know that if you have a really, really old private student loan that you haven't done anything with for years, 5 years, 7 years, 10 years, depending on where you live, you might be protected against debt collection lawsuits by a state statute of limitations. So unlike federal student loans, state consumer laws treat these just like any other kind of student debt or any other kind of consumer debt. So I'm going to end this presentation with a cheat sheet here that I'm not going to walk through, but know that this exists in this presentation. This is the escalated email addresses for customer service reps at all of the biggest student loan companies in the country. So we know that these companies have reduced their call center staff. Everybody's working from home. It's impossible to get straight answers from companies right now because the pandemic has caused them to manage their workforce in a way that just makes life impossible for their customers. So what we have here are the escalated customer service contact information for the biggest student loan companies in the country, and also their Twitter handles. And we've seen people get really good, quick responses from these companies just by tweeting at them and airing their challenges with their student loans publicly. Companies tend to be much more responsive than if you just call a phone number and have to wait on hold and hope you get somebody that knows what they're talking about. So with that, we are happy to answer any questions that folks might have. I apologize that this slide is kind of tough to read. I think I might have accidentally clicked on the link on the slide before I shared it. But protectborrowers.org/coronavirus. That's protectborrowers.org/coronavirus. All of this information lives on that website, along with FAQs, a recorded version of a longer presentation, and lots of other resources, including where to go for help. So with that, I think we're happy to answer any questions.
Yep.
And I know we only have a few minutes left, but we would also be happy to answer any questions that trail in afterwards too.
Mike, thanks so much. And thank you for everyone who's been here for the presentation. We hope you found it informative. So we wrote in the chat box, we're now in the Q&A period. So if you do have a question, please enter it into the Q&A box. Mike, our first question, could you speak about the difference between income-driven repayment plans and income share agreements, and maybe what income share agreements are?
Sure. That's a question we don't get that often, in part because income share agreements aren't really widely available for most students. But an income share agreement is a financial product that's new. It's offered by private investors, often backed by schools, but there really are only a few schools that offer them at this point. And they make you sign a contract that commits you to repaying some amount of money that they extend to you over some period of time as a share of your income. And there are some challenges that borrowers have experienced with these products. Again, they're very new and kind of untested. And where schools do give people access to federal student loans, they're offered as an alternative to private loans, as kind of a loan or a financing of last resort once you've exhausted your eligibility for federal student loans and for Pell Grants and GI Bill benefits. So the best piece of advice about income share agreements that I would give is never take one out unless you understand all of the things that you're signing up for, and also, most importantly, unless you've used every other source of financing you have available, because they are risky and they are new, and the terms and conditions aren't always clear to borrowers when they're trying to figure out whether they make sense. Just this month, we joined with National Consumer Law Center to file a complaint with the Federal Trade Commission against the largest provider of these companies, or of these products, for deceiving their customers about the cost of these options. So know that they are something totally separate from a federal student loan with an income-driven payment plan, and that they have different terms and conditions, and your rights are what they are based on the contract you sign. And so they really should only be used as financing of last resort if you've exhausted all of your other options and you understand exactly what you're signing up for.
Great. Thanks, Mike. Our next question, if someone's in default and is currently working with a collection agency to rehabilitate their loans, how do they get removed from the federal list that may prohibit new home loans or refinancing?
So the best thing that you can do is get out of default on your federal student loan. It's hard to figure out how to navigate that, but working with your collection agency to rehabilitate your loan isn't always the fastest way to do that. The fastest way to do that, if you're eligible, is to take out a new direct consolidation loan and pay off your defaulted loan. And once you've done that, you should be eligible to access federal programs that are otherwise prohibit people who are in default on a debt from accessing them, on a debt to the federal government to for accessing them. And that's not just things like FHA-backed mortgages or other kind of federal home ownership programs. The Paycheck Protection Program that Congress passed in the CARES Act to help small businesses keep the lights on during the pandemic also prohibits small business owners from accessing that program if they're in default on a federal student loan. So it's really important to know how to get out of default. There was some good information in this slide deck that I glossed over, but follow that roadmap. There's more information on our website at protectborrowers.org/coronavirus. And once you're out of debt, you should be able to restore access to federal home loan programs, not just restore access to programs like PSLF and IDR.
Great. Thanks so much, Mike. And like Mike said, all this information, including the presentation from today, FAQs, are all available either on our website, protectborrowers.org, and for all attendees, we will send emails with the presentation and links so they can go back through. If there aren't any other questions, I believe we will now wrap up the presentation. I'm going to hand it back to Mike Saunders to close us out.
Thanks, Walter. I'd like to thank our panelists, Jen, Corey, and Mike. And I was remiss before not thanking Jared Toma for sharing his story with us. And thanks, everybody, for your time and expertise. And thank you to everyone for listening in, and thank you for your questions. Hopefully, we were able to let you know about legal rights and government programs that can help you deal with your student loans, whether you're still on active duty or military spouse, or you're a veteran or a survivor. If you still have questions, you can reach out to Veterans Education Success to talk to our free lawyers. Email us at help@vetsedsuccess.org. That is VETS edsuccess.org. Thanks all.